Calling all boomers. This is for you. If you're in your 50s or 60s, we're going to talk about required minimum distributions today. My name is Rizek, CPA and certified financial planner. I'm going to break it down for you. So, if you didn't know, if you've got money inside of a pre-tax retirement account, IRA, 401k, pension plan, 403b, you get the picture. When you reach a certain age in your 70s, the IRS is going to say, hey, it's been fun, it's been real, but it's time for us to get a slice of the action now. And they're going to start forcing money out of your retirement accounts so that they can tax it. And of course, when they force that out, it is taxable income in the year that you receive it. Now, there's a formula that they use to determine how much every single year they're going to force out. It's a combination of your age and the previous year's ending account balance. So if you didn't know, a couple years ago, back in 2019, they passed the Secure Act, which changed the age at which you must start taking required minimum distributions from your own pre-tax retirement accounts. They changed that age from 70 and a half to 72. Then just recently, with the passage of Secure Act 2.0, they changed that. That age was changed to 73 in the year 2023. Now come 2033, it will be age 75. So it seems like they keep pushing it back. Now, before I continue on, one thing they forgot to change was qualified charitable distributions, QCDs. And if you donate to charity or tithe to a church on a regular basis, wow, that's an awesome tax planning opportunity. Check out my other video on qualified charitable distributions. It's a great way to avoid both state and federal income tax on these required distributions if you donate to charity. Okay, so back to required minimum distributions. Why does the IRS have them? Well, when you made a deductible contribution to a retirement account years while you were working, you essentially partnered with the IRS. Said, hey IRS, you and I are going to partner up together. You're going to give me that tax deduction now. And then in the future, I'll pay you out. Well, now the time has come. The IRS wants a slice of the action. They want to get paid out. And so they start forcing you to take these required minimum distributions. That gives you an awesome tax planning opportunity between now, if you're in your 50s and 60s, and when you are forced to take the required minimum distribution out in your 70s. Now, typically, we call this a Roth conversion. That's probably the number one strategy that most boomers make at this point in life. That's where you take a specific amount of pre-tax retirement assets and convert them to Roth. Now, when you convert them, that is taxable income in the year you convert them, which is why we typically don't convert the whole balance all at once. But it can really make sense in between when you quit your full-time day job and required minimum distribution. I'm Rizek. Follow me for more tips.